And 501 defines an accredited investor. Simply stated, an accredited investor would be someone that the government doesn't think they need to protect.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey guys, welcome to today's show on Wealth Strategy Secrets. We've got another great show for you today. Today we're joined by Gene Trowbridge. As a founding partner of Trowbridge Law Group, Gene's law practice concentrates on the syndication of commercial and investment real estate through both debt and equity. Gene has represented over 650 clients in this area of practice. The average offering size is $3 million, but he has done individual offerings of over $6 billion. His practice writes offerings under Rule 506B and 506C of Regulation D. As a former syndicator who for 10 years raised investor capital through the broker-dealer community, he is able to communicate with his clients on both the technical and the practical aspects of state and federal securities laws. As a longtime CCIM and CCIM senior instructor, Gene has won numerous awards for his teaching ability. His book, It's a Whole New Business, is a how-to manual on real estate syndication. Gene, welcome to the show.
Well, thank you, Dave. I appreciate you having me on here. It wasn't necessarily the easiest thing we've had to do today, but it worked, right? You're in Florida and I'm not. I'm in California. It's raining like hell here. So we live in a desert, so this is kind of unusual. But
yeah, well, at least we're not in Buffalo, right?
Yeah, that's for sure. You know, I'm a Minnesota native, so I got out of that.
Okay.
And I'm well aware of those memories. That's for sure. In fact, this is more than anyone needs to know, but I played a lot of hockey in my youth, which was a while ago, and a lot of frostbite. And I still, when I go like to Chicago, I get to Chicago quite a bit. But if it's in the wintertime, my feet are still cold. They're just very cold all the time.
Yeah, no fun. I gave up winters and state taxes, so glad to move further south. But,
well, good for you. Good for you.
No, really appreciate the time, Gene. Yeah, appreciate you coming on board and everything. And you've got really such a unique background, having actually raised capital right in the private offering space before. And then moving into law from that. So I think investors are going to learn a ton. The majority of our listeners are passive investors who are really looking to, amplify their wealth. So I think there's going to be some great insights you can provide, from that legal perspective in terms of them doing due diligence, things to look out for and such. But perhaps we can start off giving a little bit of background and how you got into the space and how it all started for you.
Okay, Dave. Well, I started as a commercial real estate broker back in Minnesota, selling commercial real estate out of college. I had an accounting degree, but I didn't want to be a CPA. So I went to sell the biggest ticket item I could find, which was real estate, and did that for a while. And then so many of my clients, I got to a point where I was buying real estate on my own as an investor, and I came across a property that was too big for me to buy myself. So I needed to raise money from other people, and that's how I learned the word syndication, and that's how I learned what a security was. And so really the first half of my career was broker, commercial real estate broker, and syndicator. We did, I did 16 offerings, and most of them had 2 properties in each offering. And we built self-storage throughout Southern California. Poured a lot of concrete, painted a lot of doors orange because we were selling our projects at the time to public storage. In those days, they weren't building, they were just buying in existing properties. So I did all that and was raising the money through the broker-dealer community. And then one day, a couple things happened that really turned me to face growing my business in a way that I didn't want to. And so I went home to my wife and we sat around the kitchen table, Dave, where all the great decisions in my life have been made. And I said, I think I'm through with this. To get bigger, and in those days, there weren't back office companies that could help you with this. You were doing everything yourself. To get bigger just wasn't in my comfort level. And I said, I think I'll do what I always wanted to do. I'll go to law school. So at 42, I enrolled in law school. And at 45, I passed the California bar. And ever since, I've been doing this. And I knew when I went to law school, I was only going to do one thing. I was going to come out and be a securities attorney. And that's what I did. I have had a couple partnerships. My current firm now is Trowbridge Law Group. There's 6 of us, and we work totally virtually, and we're all around the country. So it's been a good run. And as you said in the introduction, having some practical experience and probably having made some good decisions and some bad decisions helps me when I work with my clients who, you really have to make sure that what your clients are doing is supportive of the passive investors, because that's what it's all about. It's really not, Dave, a real estate business so much when you get to be a syndicator. It's a people business. The syndicators, I always say, everyone thinks a syndicator has all their money. The syndicator doesn't, but that's what everyone thinks. So they want to make sure the syndicator is managing their money in the right framework. And that's what the securities laws are all about. Did the syndicator give the investor full disclosure before they invested so they could make an informed decision? That's one whole syndication law about that. And then the other one is, are there quality people out there raising money to put in syndications? And so that's the other securities laws, both from 1933 and 1934, full disclosure, and let's see if these are the right people that are raising money. So, yeah, it's great. You say you have, and I'm just babbling, you say you have a lot of people in the passive world. I love it, Dave, when I get a call from people who have been in the passive world for a long time, and they say, Gene, I've done this. I've been in 10, 15, 20 deals, and now I want to be a syndicator. And that just stops me. And after an appropriate pause, I say, why? Why would you want to do that? Aren't you doing well as a passive investor? Oh, yeah, I'm doing well, but I could make so much more money. And then my comeback is, yes, with so much more risk. So it's an interesting change from being a passive to a syndicator. But I think there are a number of things that a passive investor should look at while they're looking to invest. So you probably have some questions.
Yeah, no, that's interesting insight, Gene. Definitely the risk factor, I think, is very much underestimated. But I think what folks in the audience probably want to really understand, and let's just really level set, right? Because a lot of people are just used to investing in Wall Street, right? And then might get into the private space and do their first syndication. So all of this is new to them. The Regulation D exemption, what is 506B, what is 506C, all of these things. So maybe we can kind of level set and just, can you articulate really the current securities law as you would to a new investor who's never invested before?
I could, Dave, but I think there are some questions that your passive investors should ask before we get into the weeds. And if there are any syndicators out there, I think they better know how to answer these questions, or their duty to the investor probably isn't being fulfilled. And we want to make sure that the investors are okay. The very first thing I think a passive should ask is, well, Dave, I like your deal. I've got the $50,000 and I'd be happy to invest with you. But Dave, what happens if something happens to you? That's a stopper right there, isn't it? You better have an answer. Our company won't take on a client who says, well, we'll figure it out. No, we need to have that up front. We need to have a manager LLC with at least two people. The lender is going to require that there are at least two people so someone can take on. I'm not just talking about death. We've had COVID, we've had hurricanes, we've had all sorts of things that have happened that have diminished the sponsor's capability of managing the money that other people have given them. So it's important to have continuity. The next thing I think an investor should ask is, have you done this before, Dave? And if Dave has to answer this question, no, well then what does Dave have in his bag of tricks, in his experience, to tell that investor that just because I haven't done this before, that doesn't mean you shouldn't invest with me? Because all of us have had to answer the question, no, I haven't done it before. We all need to get past our first deal. And I'm not saying that a passive investor shouldn't invest if the person hasn't done a deal before. I'm just saying that what else is there? Well, in my world, when I went out to do my first deal, I probably owned 10 properties. And I was a CCIM. I was teaching people. I had a college degree. I had some background. And the first people who invested in my first deal were people who knew me. And that's where you're going to have to start. So I always laugh. You need to be able to say, when someone says, have you done this before? You need to be able to say, hell yes, once. You need to get that point. You get that point. The next thing I think you should ask is, hey, Dave, you're going to have any skin in the game? Skin in the game can be money you're going to invest, can be the fact that you're going to have to sign on the note. Whether it's recourse or non-recourse, there's still liability on your part if you sign on the note. And I think an investor needs to know, a passive investor needs to know that the syndicator's in this deal with them. They've invested their own money, their own time, they're willing to take the risk, and it's a team. It's a team event. And then the last thing I think the investor should ask is, hey, if I need my money back, Dave, how does that work? And then Dave needs to know what his operating agreement says about liquidity, right? And it needs to be able to explain it in a method that the client can understand. And those are the first four questions I think anyone should ask in determining, doing due diligence on the syndicator or on the deal. And we haven't even talked about cash flow. We haven't even talked about what product type it is. Those are just, Dave, those are just crucial questions. And you can do a securities offering if you don't have the answer to those questions. That's fine. I'm more concerned right now in protecting investors and being successful in marketing in those particular questions. Was that okay?
Yeah, totally agree with that, Gene. We have at Pantheon a very extensive due diligence process that includes every one of those questions and many more. But I like how you summarize them in terms of priorities, right? Because let's face it, everyone is busy, right? As a passive investor, people are busy. So you need to be able to prioritize your own due diligence, ask the right questions of the team, 100% agree with that. So people feel comfortable in terms of making that investment.
I think that's right, because one of the things is that the investors are out there looking at a lot of deals. And unfortunately, sometimes it comes down to one deal is promising or projecting a 6% cash on cash, and the other one is projecting 4, and the investor makes a decision based on 6 versus 4. And that's a good question to ask, and that's a good way to make a decision. But after some other questions get answered, in my opinion, in the securities laws, I mean, that's really the realm of the sponsor, of the syndicator. What I think the passive investor needs to know is, for the most part, the syndicator is going to be raising money from people that they know, and they won't be advertising broadly to the public through social media or anything else. So if that's the case, then when the passive investor reads the documents, which is one of the biggest mistakes we all make, the syndicator and the passive, is don't read your documents and don't follow your documents. Boy, that's terrible. But when the passive reads the documents, they will see all sorts of garbled stuff about securities law, and they will see 506B as in boy pop up. And that's a regulation that allows the syndicator to raise money from people that they have a prior relationship. I think the term is pre-existing and substantive. And that's where most of the money is raised. Dave, the last figures the SEC came out with, and they're about a year old now because they'll come out with new figures in March, was that this private placement business, which is what we're talking about, was $2.2 trillion in the last 12 months that they analyze it. That's huge. That's bigger than the IPO market on Wall Street. And 94% of that money, which is a lot of money, is raised in 506B offerings, where the syndicator, the sponsor, is going out and raising money from people with whom they have a relationship. Now, that's a little clouded because most of the money is raised in the broker-dealer community, and broker-dealers, through their educational events, their financial planning consultation with people, they have investors. They don't need to advertise, and they don't want to advertise. They already have this is going to date me, they already have the Rolodex or their computerized list of investors. And so all those people are people with whom they have a pre-existing substantive relationship. That's where the money's raised. My most prolific client, since I started keeping track in 2014, has done 164 offerings with me, Dave, and they're all 506B. And he even goes so far as to say, I'm only taking accredited investors. And so these are all people he knows. They're all rich and smart, so they can read the documents. They can absorb the risk in the type of deals that he does. And he doesn't do any advertising. In fact, his database is closed. You couldn't get in his database to invest today. So that's what most people are going to find. And that rule, way back, that rule came out in 1981, and that was the rule. Raise as much money as you can from as many accredited investors, up to 35 sophisticated investors, and no advertising or solicitation. And that went on till 2012. Jobs Act came along and added the ability to broadly solicit, to advertise and generally solicit. And so they said, well, we'll call what we always called 506, we'll call it 506B, and that's going to stay the same. But we're going to add 506C. And in 506C, we're going to let people advertise. You can actually, Dave, you could go on social media and try to raise money from people you don't know. You can imagine that's a challenging marketing position without a track record, okay? Because I'm not going to send you a check for $50,000 if I don't know who you are, okay? You better have a good track record, and there better be some way that I can communicate with you ahead of time. But 506C is out there, and if well over 90% of the money is being raised in 506B, that means there's a very small amount of money that's being raised in 506C. So most of your investors are going to come into the investment group with a syndicator or a sponsor that they have some familiarity with. Don't you see that's the case?
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Yeah, I was going to ask you, Gene, if you saw the industry making a shift, more towards 506C. It seems that's kind of what I'm seeing, is the industry kind of really shifting that way.
Well, no. In my company, and we do a lot of offerings, 10, 15 a month, we might do one 506C every month. And in many cases, that's a relatively new syndicator who might have some track record, but wants to generally solicit and advertise to build their database. And so if they can go out there and talk to people and get people they don't know and then bring them into their database and get a relationship with them, and sometime in the future, they'll step back and do a 506B offering with those people. The other thing I see is a lot of syndicators, and you might have noticed this, have raised a lot of money in the last 5 or 6 years. And it's possible that their clients are tapped out, that their money that they have to invest in real estate is already invested. And so my client isn't positive they can do another $10 million offering with existing clients. So they come out and they do a combination. Have you seen this where they talk about a combination of a B and a C in the same offering?
I have not seen that. No.
Okay, that's something that's relatively new. And in 2021, some rule came out on integration from the SEC that made this possible. And how I write my documents for that, Dave, is we would start your offering as a 506B, people you know, up to 35 sophisticated investors. And then we put in the offering document that at some point in time, we might switch to a 506C. When that time comes, it's the same offering documents, it's the same information, but now we can go out and advertise. And from that point on, we can take new people into the fund that we don't have a pre-existing relationship with. The important thing is we have to be definitive about that point in time where we change from a B to a C. And how we do it is we send a Form D to the SEC and say, okay, our 506B offering section of this is over. And then we send them another Form D that says our 506C part of this offering has started. And then all the rules about a 506 advertising and third-party verification and all that apply toward the end. But most of my people who do that want to do that for one or two reasons. They're pretty close to closing, or they think they can raise all the money, so they write it up so that maybe for the last $1 million, they're going to advertise to get new investors into their database. Right? And the other side of the coin is, hey, I don't know where the next million is coming from. We may need new investors just to get that next million. So that's probably the newest thing that a passive investor would see in reading through the documents. They'd see both 506B and C. In there, 506B is a little easier to do because you and I are accredited investors, and if we go into a 506B, we just check the box that we're accredited. But if you and I were
versus a
going
C,
into an investment where the syndicator's advertising and doesn't know us, because they don't know us and it's advertising, we need a third party documentation that we are accredited. Well, when I talked about my most prolific client, none of his accredited investors want to go to a third party and show their tax return or anything like that. So he just stays in 506B. All they have to do is check a box.
Yeah, so Gene, let's talk about that for a second, right? Because we have done both 506B and 506C offerings. And in terms of the accredited investor status, help the audience understand, number one, why is the SEC asking that and requiring that? And then number two, what are the best ways to, procure your accredited status? And also further, right, if you're on the fence or you have certain assets, like let's say you have some single family rentals, and how do you put a valuation on some of those assets, right? They're not like market-based assets in Wall Street.
Great question. When the securities laws were passed, there was no advertising allowed at all back in 1930s. And in addition to that, you could only take people who were, quote, rich and smart. Okay? No one knew what that meant. And in 1981, the SEC came out with Regulation D. And in Regulation D, they cleared all that up. In Regulation D, the first rule is Rule 501. And 501 defines an accredited investor. Simply stated, an accredited investor would be someone that the government doesn't think they need to protect. Back to being rich and smart. You've got some money. You should be able to read the documents. You should be able to understand what's going on. And if the syndicator follows the rules of full disclosure, we don't need to protect those people. It's the people who aren't rich and smart that we need to protect. So definitively, 1981, in the edition of Regulation D, put some markers down. And the only marker they put down at that time is if you had $1 million net worth, and or you made $200,000 a year if you're filing an individual tax return, or $300,000 if you're married, filing jointly. You met the definition of accredited, rich and smart. There was never really a word like accredited until 1981, and they defined it simply with dollars and cents. And with little change, that's still the number one way that we look for accredited investors. Do they have $1 million in net worth? Do they make $200,000 as an individual or $300,000 married? Now, $1 million was something in 1981. With inflation, what is it? $2.5–3 million today? What is 200,000? Is it 750,000? I don't know. But they've never changed. They've never changed those numbers, and yet they've changed the accreditation rules several times. And I know some of the people in my space keep saying, oh, this year they're going to change the numbers, and maybe they will. It's probably long overdue. But in 2021, they had the biggest chance to change the numbers, and they didn't. What they did say is they said, okay, First of all, we're going to expand the definition of married and filing jointly to you're married, filing jointly, or with a spousal equivalent in the household. There are all sorts of households out there where there are two people who run the household, but they're not married. So why don't we let them count their net worth and their income collectively? And that was a big change, and I see that affecting a lot of offerings, the spousal equivalent change. Another thing that they did is, we say everyone has to have $1 million of net worth. Well, what if it's a family partnership? What if there are 6, 8, 10 people who are members of the family partnership, and some of them are kids? Does everyone in that family partnership have to have $1 million net worth to invest? And that would be trouble if the offering was only for accredited investors. So they came along and said, let's do this. If that entity has $5 million in assets, we don't care about the individuals. That entity is accredited. And the last thing that they did, which is kind of interesting, there has been a request for the SEC to develop a test. This would go back to Rich and Smart, to develop a test that investors would take, and if they pass the test, we would call them accredited. Well, they're not going to so far they haven't done that. Whether they will in the past, I've heard enough of the SEC commissioners say, no, we're not in the testing business. However, we do have a group of people out there who have been tested. And so they came and said, if you have a securities license in 3 different areas, you've been tested. Your background has been checked. We've investigated you thoroughly, and no matter what your income is, you're smart. So we'll call you accredited. And all those changes are always, when 506 came out, and then these changes came out, Dave, they're all to provide increased opportunity for capital formation. Because it's all about raising the capital. When you think about that $2.2 trillion that's raised, only a fraction goes into real estate. Everything else goes into businesses. There are all sorts of big businesses out there that are have their money being raised in private offerings, and they employ a lot of people. So we need to continue to promote capital formation. Long-winded answer. Sorry.
Yeah, no, Gene.
Accredited.
Yeah.
We're trying to set a rules where the SEC, in their limited resources, their limited time, won't have to protect everyone. They're just going to protect the people that need it.
Yeah, that was going to be my next question, really, is, what do you believe really, fundamentally, right, is the mission of the SEC? Are they there to, protect the investor, as you said, right, with the accredited status? Yes. Are they there to actually promote capital formation? Because, it seems that, the space in the private securities space, continues to expand. There's lots of opportunity there. So what do you really fundamentally believe that they are trying to promote?
Well, they're trying not to stand in the way of capital formation. Let's put it that way. I don't think that's their number one goal. I think their number one goal is protection of the investors. And the 33 Act, the premise of the act was to provide full disclosure of all the material facts to the investor ahead of time so they can make an informed decision. Okay, that's what that is. And then the 33 Act was, let's set up a licensing program so people who are selling securities of other people are the right kind of people, so we can prohibit and eliminate fraud in the sale of the securities after we've eliminated fraud in the writing of what the documents are. So that's their number one goal is protection.
Right.
But there are too many people to protect, Dave. Too many people. I think right now they're saying maybe 15, 16% of the households in the United States are accredited. Okay, and that's gone up quite a bit as they keep leaving the million and the 200 and the 300 alone. More and more people become accredited. Now, in 2013, well, let me take that back. Maybe it was 2008 because it came out in Dodd-Frank. They took the net worth of your personal residence out of the formula for what was your net worth in getting to $1 million. And I was out here in California at that time. And, in the coastal areas, real estate's expensive. So there are all sorts of people who are living with an ocean view in California at that time who were 65 years old, living on Social Security, and all of their wealth was in their house. They paid, $50,000 for their house, and now it's worth $2 million. They're accredited. They don't need protection. And then the 2008 crash came along, and the government said, no. So they took the value of your home out of your calculation, which makes a lot of sense. And then that cut the number of accredited investors at that time by 2/3, primarily in the coastal areas.
Yeah.
That wouldn't have applied in northern Michigan or northern Minnesota, but it certainly applied in Florida, California.
Yeah. And Gene, one question we see oftentimes from investors who are trying to get their accredited status in place is, let's say you have a business interest or you have real estate property, could be, land, whatever, commercial, single family, residential. How are you using some calculation of like mark to market in terms of valuation for that to use in the accredited test, or what is the safest way to value?
I think you have to have appraisals. My law partner, Jonathan, worked for a company that was doing nothing but 506C offerings, and he was in charge of the in-house accreditation. Now there are companies that do that. Third-party companies know exactly how to do that. But the story he tells is he had a client come to him and his net worth was in his Rolex watches. He was collecting Rolex watches. So Jonathan had to take a cram course on valuing Rolex watches to see if this guy, he had to inspect them, he had to look at them to make sure that this guy really had $1 million. Well, yes, it's complicated. That's what you have to do.
Yeah, makes sense. So, Gene, if you could give just one piece of advice to listeners about how they could, protect themselves in this world of, securities law when they're doing deals, right? What would it be?
For the passive investors, I would go through the 4 questions I asked. Then I would get the document and I would read the document. And if there was anything that didn't make sense to me, I would ask the syndicator, explain this to me. Syndicators get pretty carried away. They've got a 60-day escrow and 30 days is taken up in getting the financing and getting the documents. And now they have the documents and now they need to go out and raise the money in 15 days. They may seem like they don't have time to answer your questions, but they certainly do. So I wouldn't be bashful. Most documents today don't have an expansive track record as part of the document. But if you wanted a track record, then I think you should ask for it and see what they have. They have records. They just don't. At one time, there was a law that told you the Excel spreadsheet format of reporting your track record. Well, that law is gone. So that was a complicated thing, but a lot of information, not necessarily information that everyone understood, but we gave information. So I think I'd ask for, one of the questions was, have you done this before? Fine. So now we're dealing with the syndicator who has done this before, and I'd like at least a narrative track record of what they've done. And if they're hesitant to give it to you, then I would walk away. Dave, there's plenty of money out there to invest. There's more money than there are deals. But on the other side of the coin, there are plenty of deals. So if you have money and you want to invest, you take your time. You find the deals that make sense to you and invest there. You don't have to take the first deal that comes along.
Really sage advice, Gene. Can't thank you enough for spending your time with us today and really sharing such valuable insights to really protect investors as they invest their precious capital. We take that very seriously. So really appreciate you sharing those. If people would like to, connect with you or, explore more about some of your offerings, what would be the best place?
Well, the best place would be our website, which is Trowbridge Law Group, TrowbridgeLawGroup.com. Or our YouTube channel is great. We have a lot of educational information and interviews with 37 syndicators that I've worked with. There's a lot in those interviews. Or just send me an email directly, Gene at TrowbridgeLawGroup.com.
Excellent. We'll be sure to put those in the show notes as well, in case folks are driving. Gene, thanks again for your time. Really appreciate it.
You're welcome, Dave. I'm glad we put this together today.